No, thank you, Stephen, and thank you to CBA and PAC Partners for having the Rural Funds Management represented today. It is greatly appreciated, and our first appearance at this conference, and we hope to maintain that contact. And I would just like to reiterate my apologies that my colleague Tim Sheridan did have to withdraw at late notice. So in terms of the order of events for today, I suppose my description will be changing a little bit tack somewhat. And primarily that's because, of course, our business model is not operating agricultural assets, but it is leasing agricultural assets. Now, that doesn't undermine the principle that, of course, the model itself and the assets themselves need to be sustainable. Otherwise, that might undermine the abilities for our lessees to pay the rent, which is not what we want to achieve. So what I thought I would do today is take you through some of the principles that we think about from a business model perspective, as well as an asset acquisition and development perspective, overlaying sustainability when we have created the Rural Funds Group. The first thing that I like to highlight when talking about the Rural Funds Group, despite it being a property trust, is that it is managed by a manager that has extensive agricultural experience. Now, the paradox is that Rural Funds Group, the ASX-listed entity, its business is not taking agricultural earnings risk or volatility. What we're seeking to do is simply lease out farms to operators who are better placed to process and market the commodities that those assets produce. However, the external manager, Rural Funds Management by culture and by practice, is really an agricultural business. We have over 25 years experience in operating and developing agricultural assets in 6 core commodities, and it's each of those commodities that are reflected in the Rural Funds Group. So essentially, our model is looking at assets that we have an agricultural operating experience in, and then seeing if we can expose our investor base to it through a more passive model by leasing those assets. Why have the agricultural earnings experience? Because we believe having that granular insight into those industries makes us better landlords. It enables us to identify development opportunities as well as potential risks. And so that's why we've maintained that model since we listed in 2014. In terms of the sectors we're in, that was provided in the introduction. You can see there are 5 key industries. And we think about these sectors from a sustainable perspective as well. And the perspective is this: we ideally want industries where we believe Australia has a competitive, or even better, a comparative advantage, the latter having the Ricardian sense of comparative advantage, where you're utilising the advantages of a natural resource base that can't be replicated. So we look for sectors where Australia has a competitive or comparative advantage. These are sectors where the commodities are traded globally, which is also of importance to us, and Australia can be a low-cost producer of these commodities. And so what you see is the sectors like cattle and horticulture and viticulture. These are all sectors whereby there aren't high levels of labour, and labour in Australia is obviously one of the areas where we don't really compete on. Cattle grazing, in terms of our natural advantage with respect to land mass and rainfall, is another reason why we are exposed to that sector. And then with respect to horticulture, the robustness and security of our water ownership framework is crucially important to that industry, as well as the specific climatic conditions which enable Australia to be a low-cost producer of certain commodities, for example, almonds. So first of all, we look at it from a sector level. We want assets where we know them intimately, sectors that we know intimately through operating, and then we want sectors that Australia can compete in a global marketplace from a cost of production perspective primarily. Then we look at our lessee selection process. Our lessees are dominated by large corporates who have processing elements to their business as well as marketing teams, and they're wanting to create marketing share for their well-known and well-respected brands. However, they may not necessarily have the balance sheet capacity to acquire all of the assets, to fill the processing facilities and to fill the marketing teams with all of the product that they desire. And so agricultural leasing is a way that they can generate supply chain security without necessarily having to own the farm. And so we're very proud of the businesses that we've cultivated those relationships with in the context of leasing assets via the Rural Funds Group. Thirdly, and you're probably all wondering what on earth the colours are on that map. It's not some sort of political persuasive exercise. If it was representative of where we're at today, we'd all be summer dominant rainfall. But the colours are in fact rainfall patterns which are determined by the Bureau of Meteorology. And it really just seeks to emphasise the final point, and that we think about sustainability in terms of climatic diversification. And so rather than just having geographic diversification, what we seek is assets that are in different rainfall zones so that not all of our lessees would be exposed to adverse climatic conditions at the same time if you look at history. So typically different rainfall zones will go through drought or floods, etc. at different points in time. There's low positive correlation, and we believe by having that climatic diversification, we can achieve a real risk reduction for our unit holders in terms of the counterpart risk. However, that said, where we own horticultural assets that have an ongoing reliance on water, we preference ownership of high security water entitlements, and to that end, the group owns circa $250 million worth of water entitlements that are primarily leased just to our lessees for their ongoing operation. I'll get back now to the topic of today's discussion, which is sustainable cash flow growth, and we'll move into environmental sustainability in a moment. But revenue indexation and the weighted average lease expiry is obviously a way that we continue to grow cash flows for our investors. The latter point, so lease expiry, is really determined by the duration of the biological asset that is being produced or being farmed. So in the case of horticulture, our leases will typically reflect the life of the tree. In the case of almonds, our leases are 20 years or have been 20 years. And in the cases of more recently macadamia trees, we were quite pleased to sign a 40-year lease for those assets, which puts our WALE out quite some time. And certainly when talking to other property institutional investors, they'll often remark that they've never seen a 40-year lease before. However, our counterpart is quite confident that the asset itself will be able to produce for that duration of time. And in fact, they would be doing themselves a disservice were they to lease it for a shorter period of time, because they'd be losing the lucrative cash flows at the back end of that tree's life. So horticultural assets tend to be longer term leases, and then more annual crops like cropping, or to sort of to broaden the definition, cattle as well, are 10-year type leases. We have a range of lease indexation mechanisms, and the way that we keep that sustainable for our lessees primarily is through a market rent review process. And what that is seeking to do is to remove the divergence between the profitability of the operator and the lease escalators. So in other words, we don't want lease escalators creating financial hardship for our tenants. And one of the ways that we can seek to ameliorate that risk is through a market rent review mechanism, which basically at a predetermined period, usually every 5 years, will bring the income that we receive as landlords from the farm in line with that asset growth. We do that through two main strategies, which I'll touch on now. So firstly, the history of RFM has actually really been a higher and better use strategy. We sold an almond orchard a few years ago at about 20% plus above its book value, and they were properties that we acquired as sheep stations in the early 2000s, converted that to cotton shortly thereafter, and then in the mid 2000s converted those to almond orchards. And that was very much a transfer of the land as well as the water to a higher and better use, to a more profitable commodity, which supports higher rents for our investors. The other strategy that we use is productivity improvements. And this is one where we've probably been delivering on this strategy for closer to 10 years versus the 15 plus years 20 years in higher and better use. Basically, with respect to productivity, we view an asset on a 10-year life cycle. We think about improving the profitability for the operator in the first 2 to 3 years. And then, as I touched on earlier, monetizing that increase in productivity by virtue of a market rent review in year 5. So the two key asset classes that we undertake that in, so this is the productivity improvement strategy, are in the cropping as well as the cattle segments. So the property on your left, Lenora Downs, we've owned that for approximately 5 years. And the way that we've improved the productivity for the operator on that asset is by increasing the irrigation area. So the area that can be planted to irrigated cropping, improving that percentage by virtue of increasing the water holding capacity of those farms. So what we've done, the map provides some detail, is we expand the water storages on the farms, and then that enables us to expand the irrigated cropping area, which provides better returns and more consistent returns to the operators. In terms of cattle properties, our drivers really there are carrying capacity and daily weight gain. We focus on backgrounding properties, albeit we do own assets upstream and downstream by virtue of breeding properties and feedlots. But our core productivity improvement strategy is around backgrounding. So these are properties where the cattle are arriving about 175 kilos and then departing that property to a feedlot at circa 400 kilos. And what we're seeking to do by injecting capital into those assets is to improve, or increase rather, the number of cattle that can be stocked on those properties, as well as the rate at which they put on weight. How do we do that? There's 3 key ways. One is through irrigation and water. So for our large properties, if you don't have enough water, watering points on those properties, the areas will be underutilised because cattle just won't walk far enough from a water source. In terms of our smaller properties, it's just basically intensifying that. Instead of watering points in the form of small dams, we're putting in troughs again to improve that efficient utilisation of pasture. In addition to that, we're improving cultivation area as well as pasture improvement, so that basically there will be a forage crop there for those cattle, and we can take that property quite easily and quite efficiently, easily in terms of the developments themselves aren't that complex, efficiently in terms of the cost itself to develop those assets is not counterproductive. And the daily weight gain will increase materially, and the stocking rate too will probably double on areas of those properties. So Comanche is an example of that, which we recently leased to AACo. I was on a farm of ours just last week, Rewan, which is a couple 100 kilometres from Comanche, but very similar in profile. And we've owned that for 5 years. And we didn't quite double the carrying capacity, but we would have taken it from certainly 7,000 head to 10, 11,000 head carrying capacity. What we've seen in terms of that asset is we've acquired it for circa 30 million, and apologies, I should have reviewed my numbers, but I think that's currently valued within the group, certainly north of $70 million. So we've seen a valuation shift as well, some of which is attributable to productivity, and of course some of it is also just comparative sales. So I mentioned that there was 2 strategies that we seek to sustainably improve the cash flows for not only our operators but also our unit holders. The first is productivity improvements, and then secondly, higher and better use, which I did touch on earlier. We've really done that quite successfully in two sectors. Firstly, the almond orchard sector, which is on your bottom right. There's some beautiful almond trees that are in bloom. And more recently in the macadamia sector, where we're taking sugarcane farms as well as cattle properties, where we've secured reliable water to develop to horticulture, a more profitable commodity that will enable a valuation transfer. So what we'll probably, or what we expect to see is a development gain on those assets, and then the underlying metrics of the commodity itself supports a higher rent than its former use. I hope that's provided a bit of an overview on how Rural Funds Management thinks about sustainable cash growth within the context of the Rural Funds Group. And Steve, I'm not sure if you've got any questions that have come through.
We've got 4 minutes down there, so
Okay.
Early completers deserve questions, I suggest.
Well, I'll start with a question. Just at the beginning of the presentation there, you had poultry back in the portfolio. Is that just an oversight, or are you back in poultry, or?
No, thank you for clarifying that. So that earlier slide was talking about Rural Funds Management's operating experience.
Okay.
We operated poultry assets for 16 years. What we have, the assets that we owned were approaching the end of their useful life, and that's quite a competitive sector, and consequently the return profile of those assets had changed during the course of our ownership. So the Rural Funds Group did actually own, we owned 150 odd broiler sheds that grew about 30 million birds a year, but we've since sold them.
Okay, good. And just from a next perspective, any sectors that are catching your eye that might link in with your sustainability drive?
So the manager tends to, so Rural Funds Management, which is unlisted and privately owned, tends to trial sectors on its own balance sheet for a couple of years or more before we expose it to the group. So there are some that we continue to invest in ourselves. Lamb and goats is a sector. We're also investing internally on exploring carbon opportunities across the portfolio. We own nearly 70 properties. The abatement opportunities are significant. However, we want to be very thorough in terms of ensuring that we identify the credible methods to provide sustainability credits to our investors.
Sure. Question from the floor.
I can chip in one, if that's okay. Just James, I'm very interested in how particularly international investors view an investment in your group, because it is a novel sort of offering, I think, almost globally. There's not as many of your sorts of offerings around. So I'm interested, how are they viewing it, and are you getting under pressure to show your sustainability criteria?
Certainly, more questions around sustainability in recent years, absolutely. And absolutely, they would be coming more from our offshore investors than our domestic investors. In terms of how the model has been received, I would say very well, and that's sort of reflected by the ownership on our register. And I suppose we've spoken about as an industry for many years the rising global middle class and their demand for protein and high quality food and so forth. And when you talk to some of the offshore investors, it's actually happening on their doorstep, and they really get it. So that, coupled with a relatively passive model, in so much as that we quarantine the majority of the agricultural earnings volatility, as well as having a target 4% distribution growth, they've really sort of been the things that people have, I should say, offshore investors have gravitated to.
Well done. Back to you, Steve.